Before building your portfolio, identify your objectives. Are you seeking regular income, long-term growth, or a combination of both? Your goals will determine the types of investments you prioritize and the level of risk you're willing to accept. 2. Assess your risk tolerance. High-yield investments often carry higher risks. Determine your comfort level with market volatility and potential losses. Conservative investors might lean towards stable options like dividend stocks or bonds, while aggressive investors may explore REITs or high-yield ETFs. 3. Diversify across asset classes. A well-diversified portfolio reduces risk while maximizing returns. Dividend stocks. Choose companies with a history of consistent dividend payments and solid growth potential. Real estate investment trusts, REITs provide exposure to real estate markets and typically offer higher than average yields. High-yield bonds. Corporate or municipal bonds with higher interest rates can provide steady income. Peer-to-peer lending. Platforms like Lending Club allow you to earn interest by lending money directly to borrowers. 4. Research high-yield opportunities. Not all high-yield investments are created equal. Look for companies or funds with strong fundamentals, stable cash flows, and reliable management. Use financial tools to analyze key metrics like dividend yield, payout ratio, and debt levels. 5. Consider high-yield ETFs and mutual funds. High-yield ETFs and mutual funds allow you to access a diversified basket of assets. Options like the Vanguard High Dividend Yield ETF or SPDR Bloomberg High Yield Bond ETF provide exposure to multiple high-yield investments with less individual risk. 6. Monitor fees and expenses. High expense ratios can eat into your returns. Focus on low-cost investments to maximize your earnings. Be cautious of overly complex investment products with hidden fees. 7. Reinvest dividends and interest. Leverage the power of compound interest by reinvesting any dividends or interest you earn. This strategy accelerates growth and helps your portfolio generate even higher yields over time. 8. Stay updated on market trends. High-yield investments can be sensitive to interest rate changes and market conditions. Stay informed about economic developments and be prepared to rebalance your portfolio if necessary. 9. Diversify geographically. Adding international high-yield stocks or ETFs can increase your portfolio's resilience. Different markets offer varied opportunities, reducing dependence on a single economy. 10. Regularly rebalance your portfolio. Market fluctuations can shift your portfolio's allocation over time. Rebalancing ensures your portfolio stays aligned with your risk tolerance and financial goals. Building a high-yield investment portfolio requires a mix of careful planning, diversification, and ongoing management. By combining consistent research with disciplined investing, you can create a portfolio that generates substantial income while achieving long-term financial growth. The key is to start today and stay committed to your financial goals.